Welcome back to the Deep Dive. It is good to have you here. Today, we are turning our attention to something that sits right in front of us, something most of us probably stare at every single day without, realizing just how powerful and, frankly, how complex a financial tool it actually is. We are talking about the home.
Right. And usually when we talk about a home, we're talking about shelter. We're talking about the emotional stuff, a kitchen where you make coffee, a backyard for the dog, a place to sleep. But if you look at the stack of documents and research we have in front of us today, the global financial system sees your home very, very differently. They don't see a sanctuary. They see a massive locked up savings account, a block of frozen capital that they would very much like to help you thaw out.
Exactly. We are diving deep into the ELOC, or the home equity line of credit. Now, I know I can hear the listeners' eyes rolling already. ELOC sounds like a dry, dusty banking term. But stick with us, because when you actually unpack this, and we are going to unpack the math, the history, and the risk today, it is a fascinating story. It's fundamentally a story about how homeowners have been taught to turn their walls and their roofs into liquid cash.
It is, and it's not just a story about cash. It's a story about risk transfer. It's about the global economy. And as we dig into these sources, what's really fascinating to me is how this one financial product tells a completely different story depending on where you are on the map. It looks one way in the United States, a completely different way in Canada, and it is practically a brand new, almost alien concept in places like the UK and Brazil.
That was the thing that really jumped out at me from the reading. I mean, we tend to assume finance is global and standardized, right?
Right.
But here, you have the U.S. and Canada, where the HELOC is this massive established beast. It's been around for decades. It's culturally embedded. But then you look at major economies like the UK or Brazil, and it's treated like this cutting-edge fintech innovation that only arrived in the early 2020s.
It really highlights how distinct banking cultures are. In some places, tapping into your home's value is standard practice. It's just what you do. In others, it's revolutionary. But we also have to be honest about the history here. The HELOC has a bit of a dark side. It's not all shiny renovations and paid-off tuition.
Oh, absolutely. You can't read about this without the ghost of 2008 haunting the pages.
We can't talk about this without talking about the financial crisis. This product was a major player in that collapse. It's a tool that can give you incredible financial freedom. It leverages your biggest asset, but it's also a tool that banks can and have frozen overnight, leaving people stranded.
So that is our mission today. We are going to deconstruct the HELOC. We aren't just going to define it. We're going to look at the mechanics, the actual math of liens and ratios. We're going to look at the roller coaster history in the U.S., the stable giant in Canada, and then these late bloomers in Europe and South America. So let's start at the very beginning, deconstructing the mechanics. If I ask you for the plain English definition, but one that actually respects the complexity here, what are we looking at?
So simply put, a home equity line of credit is a revolving form of secured credit. But we need to break those words down. Revolving means it works like a credit card. You have a limit, you borrow, you pay back, you borrow again. But secured is the heavy lifter here. It's the word that changes everything.
I want to pause on that definition, secured credit. Because in the reading, there was this tension between how the bank sees that security and how the homeowner sees it. To the bank, my house is just a pile of collateral. But to me, it's where I sleep.
That's the fundamental friction. That's the whole ball game right there. When a bank gives you a credit card, that's unsecured debt. If you default on your Visa bill, they can ruin your credit score, maybe sue you, they can harass you, but they can't come take your physical assets immediately. There is a layer of protection there. With the HELOC, you are signing a document that explicitly grants them a security interest in the property. You are giving them the keys, metaphorically and potentially literally.
And this is where the second mortgage terminology comes in. I found it interesting that the industry fought so hard to rebrand this. The sources mentioned that second mortgage has a bit of a branding problem. It implies you're in trouble.
It does. Second mortgage implies financial distress. It sounds like something you do when you are desperate, when you're out of options. Home equity line of credit sounds proactive. It sounds like a savvy financial management tool. It's 100% a branding exercise. But mechanically, it refers to the lien position. And this is important for the listener to understand. Your main mortgage, the one used to buy the house, is in the first lien position.
Right. So if I go bust and the house is sold, the first lender gets paid first. They're first in line.
Exactly. They get the first cut of whatever the house sells for. The HELOC lender is in the second lien position. They only get the scraps left over after the primary mortgage is satisfied.
Which explains why HELOC rates are typically higher than regular mortgage rates, right?
Yeah.
They are taking on more risk because they are second in line at the buffet.
Precisely. If property values drop, the second lien holder is the first one to be underwater. They are the first to lose their coverage. So they have to charge a premium for that risk. It makes perfect sense from their side.
Okay, let's talk about the math of that risk. The sources kept mentioning this acronym, CLTV. Combined loan to value. I think most people know LTV, loan to value. But the combined part is where the math gets tricky.
It is. It's where everything comes together. Let's run the numbers to make this concrete because it's easier to see it that way. Say your home is currently appraised at $500,000. You still owe $300,000 on your primary mortgage. That's your first lien. Now, you want a HELOC. The bank isn't just looking at the HELOC amount, they are combining it with that first $300,000.
And the sources say they usually cap that CLTV at, what, 80% or 85%?
80% is the standard safe zone. Some might go to 85 or even 90 in a hot market, but 80 is the classic number. Lenders generally require you to keep that skin in the game. So let's do the math. 80% of your $500,000 home is $400,000. That is the maximum debt they want secured against the house. Since you already owe $300,000 on the first mortgage, the maximum credit line they will give you is $100,000.
So they are preserving that $100,000 gap, that 20% equity buffer, just in case the market tanks. They never want to lend you the full value of the home.
Rarely. Because if the market dips 10% and they lent you 100%, suddenly the debt is worth more than the asset. Banks hate that. They always want that cushion. It's their entire risk model.
Okay, so that's the setup. You get your limit. Now let's talk about the timeline, because a HELOC isn't just a standard 30-year loan where you pay the same amount every month until it's paid off. It's split into two distinct periods, and this structure seems designed to catch people off guard.
This is crucial to understand. It's a Jekyll and Hyde product. It really is. First, you have the draw period. This typically lasts about 10 years. During this decade, the HELOC functions exactly like that giant credit card we mentioned. You can withdraw funds up to your limit, pay them back, and withdraw them again. And usually during this time, you are only required to pay the interest on what you've borrowed.
Which sounds great on paper. Low payments, lots of flexibility. If I borrowed $20,000 for a kitchen remodel, and the rate is, say, 5%, I'm paying, what, less than $100 a month in interest?
Something like that, yeah. It feels incredibly manageable. It feels almost like free money. But it can be a trap because after that 10-year draw period ends, you enter the repayment period. The credit line closes, you can't borrow anymore, and suddenly the bill comes due. You have to start paying back the principal, the actual money you borrowed, plus the interest.
And that can be a massive shock to the system. The sources mentioned that sometimes this is structured as a balloon payment or a strict amortization schedule.
Yes, and either way, it's a jump. Your monthly payment could double or triple overnight because now you have to pay down that $20,000 principal over a set term, usually 10 or 20 years. If you haven't planned for that transition, it's a financial cliff. It can be a really, really rude awakening for a lot of people.
So we have the mechanics down. It's a revolving door of cash secured by your house with a 10-year honeymoon period before the real bills start. Now, let's travel back in time a bit, because the sources paint a really vivid picture of the HELOC explosion in the United States.
The early 2000s, the Wild West.
The early 2000s. I feel like we all remember the commercials from that era. Put your home to work for you. Unlock your dreams.
It seemed like everyone in the U.S. was getting a HELOC. It wasn't just a financial product. It was a cultural phenomenon.
It was. It was the era of the wealth effect. You had this perfect storm. Interest rates were dropping. Home values were skyrocketing year over year. But you also had a specific legal environment that fueled this fire. In the U.S., historically, interest paid on these loans was deductible under federal and many state income tax laws.
The famous tax hack. I want to dig into this because it feels so alien now. It's hard to even imagine this was the law. It really does. Think about the math on that. If you had credit card debt at 15% interest, that money is just gone. You pay it to the bank and it disappears. But if you move that debt to a HELOC at 5%, and then you could deduct that interest from your taxable income, the effective cost of that borrowing was incredibly low. It was almost a no-brainer.
So let me get this straight. In 2005, I could take out a HELOC, use that money to buy a boat or a luxury vacation, and then deduct the interest on that boat loan from my federal income taxes.
You absolutely could. And financial advisors were telling people to do exactly that. The logic was, why have high-interest credit card debt that offers no tax benefit when you can swap it for low-interest, tax-deductible home debt? It seemed irrational not to use your home as a bank, provided you ignored the risk.
And people did ignore the risk. Massively.
On a systemic level, yes. The assumption was that home prices only go up.
And that brings us to the elephant in the room, the 2008 subprime mortgage crisis. We know that bad mortgages were the core of the problem, but the sources explicitly cite HELOC abuse as a major contributor.
It was a huge factor, a huge accelerant. People were using their homes like ATMs to fund lifestyles they couldn't afford, banking on the idea that home prices would go up forever. When the bubble burst, the equity evaporated. And this is where the flexibility of the HELOC turned into a nightmare.
The sources mention the Great Freeze.
Oh.
I hadn't realized how dramatic this was. It wasn't just a slow decline, it was a sudden stop.
It was a panic move, a full-on panic. Banks use these things called AVMs, automated valuation models, basically algorithms that track home prices by zip code. In 2008, these algorithms started flashing red across the entire country. They saw home values dropping below that CLTV limit we just talked about.
This good realizes, uh-oh, this borrower doesn't have 20% equity anymore. They are at 5% equity, or even negative equity.
Precisely.
Okay.
And the reaction was swift and brutal. Major lenders, we're talking the giants like Bank of America, Wells Fargo, Citigroup, JP Morgan Chase, they suddenly looked at their books and just panicked. So overnight, they sent letters to borrowers saying, we are freezing your line of credit, or we are reducing your limit to zero, effective immediately.
Imagine you're in the middle of that kitchen renovation. You've torn out your cabinets, you have the contractor scheduled for Monday, and you're planning to pay him with your HELOC draw. And on Saturday, you get a letter saying, sorry, access denied.
That happened to thousands and thousands of people. It highlighted the fact that a HELOC can be revoked. It's not guaranteed money until it's in your bank account. The banks were trying to protect themselves from foreclosure risk, but for the consumer, it pulled the rug out from under them right when the economy was crashing. It broke the trust. It was the moment people realized a line of credit is not your money. It is the bank's money, and they can turn off the tap whenever they want.
So we recover from 2008. The market stabilizes eventually. But then comes another twist in the American story. The Tax Cuts and Jobs Act of 2017. This was the Trump tax cuts. This changed the math again, didn't it?
Fundamentally, the 2017 Act removed the deductibility of interest on home equity loans unless, and this is a big unless, the funds are used for substantial home improvement.
So paying off credit cards, no deduction. Buying that boat,
Yeah.
no deduction. Paying for a wedding, no deduction.
Exactly. The tax hack was effectively closed for anything other than putting money back into the house itself. That cooled the market significantly. It shifted the product back toward its original purpose, home improvement. It took away that incentive to just use it for pure consumption.
And if we look even more recently, the sources note that in 2020, during the start of the pandemic, JP Morgan Chase actually stopped considering HELOC applications entirely for a while.
They did.
That is telling. It shows that the banks still have a lot of PTSD from 2008. They are much quicker to pull back now when they smell volatility.
Absolutely. They learned their lesson. When uncertainty hits, the HELOC window closes fast. They don't want to be caught holding that bag again.
So the U.S. is this roller coaster of booms, busts, and changing tax laws. Now let's look north to Canada, because on the surface, the Canadian story looks very similar. They also had a massive boom in the early 2000s.
They did. The growth was staggering. The sources say the Canadian HELOC market grew by 20% per year in the early 2000s. It went from $35 billion in the year 2000 to about $186 billion by 2012.
That is a massive jump, and the statistic that blew my mind was the market share. HELOCs went from 10% of non-mortgage consumer debt to 40%. It basically ate the Canadian debt market.
It did. It became the dominant form of consumer credit for homeowners, and this was driven by that same wealth effect. Canadian property prices were rising, interest rates were low, Canadians felt rich, they saw their home values going up and thought, why shouldn't I use that equity?
But here's the difference. The U.S. crashed hard in 2008. The Canadian housing market didn't. It wobbled, but it didn't collapse in the same way. And the HELOC usage in Canada didn't vanish.
No, it stabilized. It kind of found a new, lower gear. Post-2008, Canadian HELOC demand kept growing, but at a much more modest 2% yearly. And this is where we see a really interesting contrast in governance. The Canadian government looked at what happened in the U.S. and said, we need to put guardrails on this before it explodes. They are notoriously more conservative with banking regulation.
Right. The sources list some very specific regulations that came down. It wasn't just a suggestion. They changed the rules of the game.
The recession pushed the Canadian government to intervene. It was a proactive move. One of the big moves was in 2011. They made HELOCs ineligible for portfolio insurance.
Can you explain that simply? What is portfolio insurance in this context?
Basically, it's government-backed insurance that allows lenders to bundle mortgages and sell them as securities. That's the securitization machine that fueled the U.S. crisis. By making HELOCs ineligible for this, Canada made it harder for banks to just churn these loans out and sell the risk to someone else. It forced banks to hold the bag, so to speak. If they wrote a bad HELOC loan, they kept it on their books. That naturally makes a bank much more careful.
And then there was the cap. This seems like the most direct intervention.
Yes, the Office of the Superintendent of Financial Institutions, OSFI, stepped in. They capped the maximum loan-to-value ratio for the revolving part of an HELOC at 65%.
Wait, in the U.S. we talked about 80% CLTV. Canada pushed it down to 65%.
For the revolving portion, yes. A Canadian bank can still lend you up to 80% combined, but only 65% of the home's value can be in that flexible revolving line of credit. The rest has to be a more traditional amortizing loan, so they force a much larger safety buffer than what we saw in the peak U.S. market.
That is a huge difference.
Yeah.
That is a massive chunk of equity that is legally untouchable via ELOC.
Exactly. They also tightened the underwriting rules with something called the Residential Mortgage Underwriting Practices and Procedures Guideline. It's a mouthful, but it essentially meant banks had to be much stricter about proving that a borrower could actually pay the money back. No more stated income loans. So Canada managed to keep the product, but they wrapped it in layers of regulatory bubble wrap.
Okay, so we have the U.S., the Wild West that got reined in. We have Canada, the regulated giant. Now, let's cross the Atlantic to the U.K. And this is where the story gets really weird for me.
Yeah.
The U.K. is a financial hub. London is one of the banking capitals of the world. They gave us Barclays. They have a huge fintech scene. And yet, no ELOCs.
It is an anomaly. It's bizarre when you think about it. The sources point this out explicitly. The UK historically loves copying U.S. financial innovations, credit cards, online payments. But until 2021, there was virtually no HELOC product on the British market.
Why? What was stopping them? It seems like free money for the banks.
The sources suggest it's partly due to the consolidated banking system. The UK market is dominated by a few massive legacy high street banks, Lloyds, Barclays, NatWest, HSBC. When you have an oligopoly like that, there isn't as much pressure to innovate or offer risky new products. They were comfortable with what they had. They didn't need to offer HELOCs to make money. The status quo was working just fine for them.
And what they had was the offset mortgage. I want to touch on this because it seems to be the cultural substitute that prevented the HELOC from taking off earlier.
That's right. An offset mortgage is very popular in the UK. Essentially, you keep your savings account with the same bank that holds your mortgage. The bank offsets your savings against your mortgage balance when calculating interest.
So run the numbers for me. How does that work in practice?
Okay, say you owe £200,000 on your mortgage, but you have £50,000 sitting in a savings account with that same bank. Instead of charging you interest on the full $200,000, they only charge you interest on £150,000. You don't earn interest on the savings, but you save a ton of interest on the mortgage.
It's a clever product. It keeps your liquidity available, but puts it to work. You can still access that $50,000 if you need it.
It is. And crucially, it often comes with fee-free options. It's flexible. You can access your savings if you need them. So for a long time, this filled the gap. It allowed people to use their liquidity to reduce their mortgage costs without needing a separate credit line product like a HELOC.
But then the fintechs arrived, the disruptors.
The post-pandemic world changed the equation. Fintech companies started looking for gaps in the market that the big banks were ignoring. And in 2021, a company called Selena Finance launched the first true UK HELOC.
And clearly there was pent-up demand. The growth stats here are wild.
They are small numbers compared to the U.S., but the trajectory is vertical. Originations jumped five-fold in 1 year, from $50 million in 2021 to $250 million in 2022.
That is massive growth. That suggests people were waiting for this. It's not that they didn't want it. It just wasn't offered.
It does. Even though the utilization per capita is still less than 5% of what we see in North America, UK consumers are starting to wake up to it. They are using it as a substitute for other loans. But there is a catch. The sources note that these new HELOCs aren't cheap. Selena Finance's option, for example, had minimum fees over £1,300.
Ouch. £1,300 just to open the line. That's steep.
Compare that to a fee-free offset mortgage, and you can see why it's a specific niche. But for people who need access to equity without refinancing their entire mortgage, maybe because they have a great fixed rate on their main mortgage they don't want to lose, it's a game changer. It fills a very specific need.
So the UK is just getting started. It's like watching the US in the 1990s, but in fast forward. Now let's go to Brazil. And honestly, if the UK was late to the party, Brazil just walked in the door yesterday.
Yeah.
But the stakes in Brazil are, well, they are terrifying.
Terrifying is the right word if you look at the interest rates. We need to set the scene here because it is a totally different economic universe.
Yeah.
In the US or UK, if you have high credit card debt, you might be paying 20%, maybe 25% interest. And we think that is predatory.
Right, 25% feels like robbery.
In Brazil, revolving credit card debt rates can surpass 430% per year.
430%. That sounds like a typo. It sounds illegal.
It's not. It is one of the most expensive credit environments in the world due to a history of inflation and default risks. And the result is exactly what you'd expect, a massive debt trap. The sources state that in 2022, nearly 80% of Brazilian families ended the year in debt. It's a systemic crisis.
So in this environment, a HELOC isn't just a nice-to-have for a kitchen renovation. It's not for buying a boat. It's a lifeline.
It's an escape hatch. Exactly. HELOCs simply didn't exist there until 2023. A fintech called Zillitrade was the pioneer. They got authorized in June 2023.
And the value proposition is just basic math. It's undeniable. If you can swap a 430% loan,
right.
What are the HELOC rates in Brazil?
Well, Zillitrade's pricing is roughly the interbank rate, which is called the CDI, plus a flat monthly rate of about 0.99% to 1.99%. When you crunch the numbers annually, you end up somewhere in the 20% to 30% range usually.
Which to an American listener still sounds incredibly high, 30% interest.
It's astronomical by U.S. standards. But if you are currently paying 430%, a 30% loan is a miracle. It represents an average savings of around 95% compared to other revolving credit lines. You aren't taking out this loan to build a pool, you are taking it out to pay off the credit card that is eating your salary alive.
Saving 95% on your interest payments. That is life-changing for a family drowning in debt. It's almost a form of financial triage.
Absolutely. It's a revolution in efficiency. You are taking the asset people have, their homes, and using it to break the cycle of hyper-interest debt. The market potential is estimated at around 420 billion Brazilian reais. It's huge. It could fundamentally change the financial health of the Brazilian middle class.
It's fascinating that in the U.S., we worry about HELOCs causing debt problems, people spending too much. But in Brazil, the HELOC is the solution to debt problems.
That's the duality of finance. In a low-interest, stable market, leverage induces risk. In a hyperinflationary or high-interest market, secured leverage provides safety and stability. It's all relative. But it required a legal shift, too. The sources mention alienation fiduciary.
That sounds like a sci-fi term.
It basically streamlined the foreclosure process. It gave lenders the confidence that if they lend at 30% instead of 400, they can actually recover the asset if the borrower defaults. Without that legal change, the product couldn't exist. The risk would be too high for the banks.
So we've toured the world. We've seen the different flavors of this product. Let's bring it all back together in our synthesis. We need to talk about what people actually use these for and revisit the risks, because I don't want anyone listening to think this is free money.
Right, and it's definitely not. If we look at the data, the primary uses are consistent globally. Home improvements is number one, which makes sense. You are putting value back into the collateral. You are using the house to fix the house.
And the other big ones.
Education, medical bills, and property investment. These are what we call lumpy expenses. Big costs that come all at once that most people don't have the cash on hand to cover.
And the sources specifically mention most people choose not to use HELOCs for day-to-day expenses.
And that is wise. You do not want to be buying groceries with your house. That is a slippery slope to foreclosure. You should match the lifespan of the loan to the lifespan of the purchase. A kitchen lasts 20 years. A mortgage makes sense. Groceries last a week. A 20-year loan for groceries is madness.
Let's talk about that risk profile again. Because there's one specific mechanical detail we skimmed over earlier that is crucial right now, especially in a rising rate environment: the variable rate.
This is the variable rate trap, and it's a big one. Unlike your primary mortgage, which in the U.S. is often locked in for 30 years at a fixed rate, HELOCs are almost always variable rate products based on the prime rate.
So if the Federal Reserve raises rates to fight inflation,
Your HELOC payment goes up immediately, sometimes the very next month. And this is dangerous during that 10-year draw period.
yeah,
You might have borrowed $50,000 thinking, oh, the interest payment is only $200 a month. But if rates spike by 2 or 3%, that payment can jump significantly even before you start paying back the principal.
and lenders view this as low risk, as we said.
Low risk for them because
No.
they have the house, they have the collateral. For the borrower, the risk is existential. You are risking your shelter. It's important to remember that asymmetry. The bank is betting on the house. You are betting on your future cash flow.
It really forces you to think about the definition of ownership. You sign the deed, you get the keys, you think, I own this. But if you have a massive mortgage and then a massive HELOC on top of it,
If you don't own the house, you own the debt on the house. You are renting the money to live in the house. And the HELOC allows you to rent even more money against it. It keeps the bank as your landlord effectively forever.
so what does this all mean? We've traveled from the saturated roller coaster markets of North America to the regulated stability of Canada, and then to these emerging frontiers in the UK and Brazil.
I think the big picture here is the globalization of debt mechanics. We are seeing a convergence. Whether it's a fintech in London or a bank in Sao Paulo, the financial system is figuring out how to extract liquidity from real estate in every corner of the globe.
And for the consumer, it's a double-edged sword. It could be a wealth builder allowing you to fix up your home or pay for college. It can be a crisis accelerator, as we saw in 2008. Or, in the case of Brazil, it can be a lifeline against predatory interest rates.
Precisely. The tool itself is neutral. It's just math. The impact depends entirely on the context, the economic environment, the regulations, and the discipline of the borrower.
I want to leave our listeners with a final provocative thought to mull over. As we see these fintechs breaking down barriers in conservative banking markets like the UK and Brazil, are we moving toward a world where debt is completely homogenized? And as housing prices fluctuate, does tying your liquidity to your home make you financially free? Or does it just mean you never truly own anything because your life is constantly leveraged against your roof?
That is the ultimate question. Is liquidity freedom, or is it just a longer leash?
A huge thank you for guiding us through this global tour of home equity. We unpacked the math, we survived the history lesson, and hopefully we made you think a little differently about those four walls you live in. And thank you to you, the listener, for deep diving with us. We'll see you in the next one.
Thanks for listening.